Thanks for being here, everyone. I'm Gary Brode. I run Deep Knowledge Investing. We work with institutions, people like you, to help you get better returns in the stock market.
Yeah. Move the mic closer.
Oh, it's going.
Yeah, now green.
All right. All right. Maybe now you want me to keep it further away.
That's the extent of my technology now.
That was nice. So I had the pleasure of addressing this group a little over a year ago to talk about the situation in Japan. And I was here with Mark Rosano of C6 Capital, and we told all of you that Japan was facing a sovereign debt crisis. The issue that Japan had was a debt to GDP number of about 260% and a 10-year yield that was still in the neighborhood of zero, and some of the Japanese government bonds still had a negative yield. That's obviously not sustainable. What happened was, as the US Federal Reserve, the Bank of England, the European Central Bank started to raise rates, we had the predictable problem that we would see in Japan. Without the Japanese government raising their interest rates, their currency started to fall. Because why in the world would you hold yen yielding zero or negative, depending on your duration, and when you could have earned 3, 4, 5% in US Treasuries? So what happened was the yen last year fell about 35%. So I want all of you to just take a minute and think, okay, well, wait, there's foreign exchange, who cares? Doesn't matter. Here's why this matters. Anybody in this room annoyed, irritated, bothered by inflation for the last few years? I'm the only one? Everyone? Okay. So now I want all of you just a little math in your heads, nothing complicated, you don't have to get your calculator out, right? But now imagine living through the last few years of inflation we've had, plus another 35%. Anyone want that? All right. Well, it gets worse in Japan because it's a small island nation that is not rich in natural resources, especially energy. And energy gets priced in US dollars, right? So remember when we were all angry about paying $4 or $5, in California $6 a gallon of gas to fill our cars? Now imagine doing that in yen, right? It's a disaster. Okay, so the easy answer to this is, okay, why doesn't the Bank of Japan just raise rates? Well, when your interest rate is zero and your debt to GDP is 260%, here's what happens next. You blow out your budget. You raise rates, but the interest on that 260% becomes substantial. And you think, okay, well, so then they have to, no, nobody cuts anything. No government cuts spending. So how do you pay the extra interest expense? You print more yen. That causes inflation. Okay, checkmate. No matter what they do, they're in a bad position. Well, that's kind of where we are right now, right? And it's not as bad as Japan, but the thing that a lot of people are missing is in the United States, our actual liabilities are almost $250 billion. Now I know it's an unthinkable number, and where that comes from is we've all seen the 34 trillion of on-balance sheet debt, right? Our national debt. But now let's add to that pension funds, Medicare, Medicaid, Social Security. That's a big one, right? And that adds up to about $200 trillion plus about 34 trillion. Give me a little rounding, $250 billion. This is a big problem. So here's where we are now. Right? So we have inflation. The Federal Reserve, a lot of people, a lot of asset gatherers are saying, oh, the Fed made a mistake. They've raised rates. They're going to cause a recession. The Fed did make a mistake, but it wasn't getting rates to 5%. Right? So we've got a Fed funds rate right now taking the middle, about 5.3%. A CPI, which is understated, at 3.4%. We have a real interest rate of under 2%. Having a 5%, a 5.5% federal funds rate, that's not a problem. Having a real interest rate under 2%, right? For all the people saying the Fed has hiked us into a recession, no, they haven't. The mistake they made was spending a decade and a half at zero and near zero rates. That's the problem. And what they're doing right now to fix the problem, right? That's what's causing us pain at the moment. But the mistake was made years and years ago. Okay, so here's the situation that we have right now. The Federal Reserve is currently at odds with the Congress and Treasury. And here's how that works, right? So our Congress has decided we're no longer going to have any spending restraint We can spend everything we want, anything we want, all the time, no matter what. There are no trade-offs. There are no costs, right? We just add to the debt. And then the Treasury Department monetizes that debt. It's just a fancy way of saying we're going to create more fiat currency units, which in this case is the dollar, right? And once we have delinked from gold, what's no longer a hard currency, it's a fiat currency, they just print trillions and trillions more dollars. Well, that leads to an inflation problem. And here's where it gets even worse. So if we go back a couple years ago, the interest on the national debt was about $600 billion. This year, we've already gone over $1 trillion. The excess spending every year, this is the on-balance sheet number. If we had off-balance sheet, it's worse. Excess spending is about $2 trillion a year. Let's assume a 4 or 5% rate, right? The 10-year right now is at 4.3, or at least it was when I looked yesterday. So that's what, another $90 billion of spending a year. So over 2 years, 180 billion, I don't know, right? And then we have a lot of debt that the government took on when interest rates were at or around zero. And so those maturities are starting to make their way through the treasury, basically the treasury yield or the duration curve. And so what we're going to see over the next couple of years is where we just saw interest expense going from $600 billion to $1 trillion. We're now going to see it going up somewhere in the neighborhood of $1.5 to $2 trillion over the next couple of years. Now, again, it's really easy to say, okay, well, but we spend so much, does it matter? Yes, and here's why it matters. We're in an election year. Is there anybody in this room who wants to argue with me that Congress, the White House, anybody's going to cut spending, cut entitlements? Anyone? No one, right? They're not going to do it. It's not going to happen. There's no possibility. This is not a partisan argument, right? Nobody from either party is going to touch entitlements. Right? And we all know what's going on geopolitically. Military spending will be cut eventually, but not this year. So what we're going to do is we're going to print dollars to pay the interest on the dollars we printed before. Now, if any of you astute people are thinking, wait a minute, that sounds a little like a Ponzi scheme, I'm going to tell you you're very, very close, right? It's exactly a Ponzi scheme. This is the definition of a Ponzi scheme. This is exactly how these things work. And so, like Japan, we are trapped right now. If the Federal Reserve lowers rates, as so many market participants are begging for them to do, we end up with more inflation. But if they keep rates where they are, we end up with $1.5–2 trillion of interest expense and have to print more currency and end up with more inflation. The Federal Reserve is trapped, and they are currently in a stealth war with the Treasury and Congress and the White House, and nobody is going to blink. And so we're a little bit stuck right now. And the whole point of the title of the book, Counterintuitive Inflation, is basically what I've just done is explain to you in just a few minutes how Federal Reserve rate hikes can not only be necessary to reduce inflation, but when you have as much debt as we have, can actually lead to an increase in inflation, which is counterintuitive to what people would expect. That's the intro.
Okay.
Right.
I think Gary's right about this issue with the dysfunction in Congress. The inflation that we had, I think, was temporal and largely caused in 2020 to 2022 period by the supply side issues. We didn't have ports, manufacturing facilities, and ultimately there was a lack of inventory. Now, I don't see that as permanent. In fact, Jerome Powell talked about the supply side issues having finally been alleviated. And explains a great deal of why we're back down in the mid to low 3% range for inflation. And producer price index is actually now negative 3 months in a row. And I'll get to that in a minute. I want to get to a bunch of stuff Gary said because they're very important. There's dysfunction in Congress, and the problem we have with this deficit is primarily that not this administration, but the prior administration cut taxes. And that tax cut is in place until it expires in 2025. But you can't cut taxes and not deal with the Medicare, Medicaid, and Social Security payments. we really need a independent commission like we had in 1983, the Greenspan Commission, that dealt with the growth rate of those transfer payments. And we just have not, what worries me about Congress and the leadership that is running is that I'm just not sure they have the I don't know what you call it. They just don't have the ability or fortitude to deal with that situation. So the spending is largely coming from the Social Security and Medicare growth. Now, the truth of the matter is we have a demographic bubble. Japan is 15 years ahead of us on the demographic bubble, which is why they have 200% debt to GDP. Europe and the US are about contemporaneous on the demographic bubble, and China is 15 years behind us. Okay, so they're going to hit it, and not only are they going to hit it 15 years after us, they're going to hit it even harder because the one-child policy exacerbates the issue. We have to run a tax policy at a higher percentage of GDP for about 20 years to deal with this demographic bubble in retirement, unless we want to renege on those transfer payments. Now, the last time this country reneged on the transfer payments was pensions to World War I veterans during the Depression, and there was a big, they went to Washington, the Army actually was brought out, they fired on them. It was a bad chapter in our history. I doubt we're going to renege on those payments. What we do need to do is get more technologically savvy in managing the Medicare costs and getting fraud out. You may have to opt out of HIPAA to receive the payments, and you have to monitor the expenditures. There are people with sleep apnea machines sitting in a closet they haven't used in 3 years, but the government's making a payment to a company every single month. Okay, we're going to have to increase. You can't say, oh, the top 5% of wage earners don't get Social Security, because guess what? Everybody gets the same amount, roughly. And so you've only saved 5%. What you have to do is you have to raise the Social Security FICA cap. You're going to have some means testing. That won't do a lot. And there's a whole bunch of forward-thinking things you're going to have to do to moderate the growth of that. The Fed is going to need to get inflation down to 2%, so this refinancing does not have the projections CBO had when they were using interest rates 6 months ago. Okay, that's already come down somewhat, but discretionary spending is actually coming down from 6.5% of GDP to 5.7% by 2031. The other mandatory expenditures, which are things like farm aid, the pension that they pay to civil workers, and that is also coming down. What is going up is Social Security, Medicaid, Medicare. So that has to be dealt with. I think to get back to a sustainable deficit, we need to be at 3% of GDP, a primary deficit of 3% of GDP. And to get there, it's going to have to be about, we're right now under the Trump tax cuts at about 17.8% this year of taxes to GDP. We probably need to be closer to 19.3, 19 to 19.5 during the baby boomer retirement era. And we've got to have this commission, whoever gets elected has to put a commission in place, and they have to make changes now that affect our costs through 2045, when the bubble starts to alleviate in this country. The point that Gary made about the currencies, it's very interesting. The dollar remains strong because the demographic issue and the debt to GDP is worse in China, worse in Europe, and worse in Japan, okay? So I hate to say it, we're kind of the lesser of the currency evils. So the dollar has actually been strengthening since 2000, and I want to say it's 2000. The DXY has been strengthening for a number of years. I forgot the chart in my head, but I'm going to say it's like the last 10 or 12 years. It's been strengthening for exactly that reason. I think that the counterintuitive inflation and so I think it is really important for the Fed to keep try to keep real interest rates at 2%, which we haven't seen for a very long time. It's been the first time in 22, 23 years it's really made sense to invest in bonds or duration. I think duration offered an incredible value in September, October before Powell's, what I call the balance of uncertainty speech. And I wrote the piece that I think we published on the website about that. And but I think that
Michael, just for everyone to know, we will publish the piece on the website. It will be accessible to members. So any guests who want to sign up for membership? Sorry.
Where I see Gary's counter to inflation taking place right now is in the 41% measure in that reported inflation that's called owner's equivalent rent. And what's happened is that the price of materials to build homes was really expensive during COVID, and it only came off slowly. Like lumber's come off, but cement hasn't, right? And you got to pour a foundation, so it's more expensive to build a home. New homes built were about 23% lower over the trailing 3-year period. So that means you've got a cumulative shortage of supply. Now with higher interest rates, everybody who's sitting on a 2.5% or 3% mortgage doesn't want to sell. So secondary market supply gets seized up. So there is upward pressure on home prices. Now it's logical that there should be. If it costs more money to build a home, replacement costs have gone up. So it's logical to me that we will see a sustained increase in residential real estate during this period. What that has resulted in is this lagged measure called owner's equivalent rent, and that has been the element that's been keeping inflation from coming down below 3%. They talked about it in the latest CPI report the other day. Working against that is that China has really got some problems economically, and they have shifted now to become an exporter of disinflation, not deflation, but disinflation once again. And I think that's why we're seeing the goods number in PPI falling. I think that bodes well for the inflation numbers as the year goes on, and I think you want to buy and hold duration assets. The last thing I'll say on this is mortgages. People can't figure out why mortgage rates have stayed so high, but the Richmond Fed, somebody at the Richmond Fed, I can't remember his name. I think his name is Gary, actually, wrote a piece about how mortgages, people think it's because of the risk in the mortgage or the prepayment optionality, and the optionality being high because the volatility of rates is high. It's actually not that. It's that a 30-year mortgage is normally priced off the 10-year. But right now you have historically high spreads. In fact, in October, in my piece I wrote, you had the highest spread to the 10-year on a 30-year mortgage since 1979, 1981, the Volcker Fed. It was a great investment. Now, what's happened is because the yield curve has done what it's done, and the anticipation is that the Fed will lower rates, the assumption is that the duration of that 30-year mortgage is very short, because anybody who has a high coupon mortgage is going to refinance it within the next, so let's say 2 to 3 years. So you're actually your base rate for that 30-year mortgage is actually like the 1-year or 2-year point on the curve. So your spread over that point on the curve isn't as high as it appears. You can get a 30-year mortgage today for 6 1/8, but you're only 75 or 100 basis points over the short end of the curve. So what will happen is those mortgage rates will come down as short rates come down. They won't be correlated to the 10-year, and that will start to ease up. That will increase home building activity, and that will increase the number of secondary supply coming on the market. That will further bring OER down in the inflation calculation. So those are but again, the unintended consequence of raising rates was it actually caused inflation to go higher because of this OER measure and these dynamics in the housing market and the way the yield curve works on mortgage pricing. So that was, and the dollar's interesting. The debt, I think, you really need some guts in Congress, and you need a commission. because we have to try to deal with this thing. And the sooner we deal with it, and you said something interesting to me, Gary, was they'll only deal with it when it's a crisis.
Well, so here's the interesting thing about that. We were having this conversation a day or two ago, and that was actually your point, and it's the same one that John Molden made.
Yeah, John
Molden. Right, I had the chance to chat with him on a
Smart guy.
Twitter. He is. I think he's an interesting guy. And you two have the same point of view, and I understand, and I think it's a smart point of view. I disagree with it. So what?
You have to disagree. We don't have a market.
Yeah, what are we going to do? I have to take a position here. So basically what John and Michael were saying is at some point things will get so bad that Congress will come to the table, they will do the hard thing, the right thing, and they'll find a way to cut spending and engage in entitlement reform. The history of these things is that empires decay inevitably. And I've yet to see any reversal in either the seriousness of the people in Congress or the economic literacy. I'm 100% convinced that Congress, with the exception of maybe Rand Paul, are economically illiterate. They do not have the intellectual capacity, nor have they been inclined to do the work to prepare themselves to deal with these issues. And again, that's a bipartisan problem. So I don't have any confidence because I've seen them. If they were to behave in a responsible way about anything, I might, think, okay, we could have confidence in them to do the right thing. I don't know that, fingers crossed, waiting for a horrible disaster, and then they're all of a sudden going to learn that modern monetary theory and Keynesian economics don't work, and all of a sudden become Austrians overnight, because literally none of them understand the difference between any of those things. So I get why you guys think that, and it's not a bad opinion, but I've just given you my reasons for disagreeing.
We're just Pan-Glossian.
Yeah.
We just believe in this, bountiful future.
But in fairness, we have a 250-year history in this country that shows that when pushed to the extremes, Americans do the right thing. And so, again, I'm going to repeat it, your point of view isn't a bad one. Americans, when pressed and pressured and, backs against the wall, we tend to figure it out and do the right thing. You got a couple hundred years behind you on that. A couple points that you made that I do agree with, that I really want to emphasize. You made this point that what we really need is entitlement reform and waste reduction in government. That's a huge thing. I completely agree with you. People have been talking about that for decades. It hasn't happened. Again, you're right, we need it. I lack confidence in the people in Washington to do it, but there's no path without that. I also like the point you made about the dollar. I'm going to rephrase it, but it's the best house in a bad neighborhood. And one of the big debates I've had with people, because I started writing about inflation, and I want to get to it because I started writing about inflation as a non-transitory thing, and I'll get back to your point on that in a minute. In November of 21, right? We were early and right on this. And so many people over the last couple of years have come to me and said, hey, the dollar's doing great, the dollar's strong. All right, hold on a minute. And it depends on your point of view. So if you're looking at the DXY, the Dixie, right? If you're a foreign currency trader, yeah, the dollar has been king. It's in great shape because everybody else, for all the dumb things we're doing, everybody else is doing that even more so, right? They're doing the same things even harder. It's like that great line from The Simpsons, right? There's the right way, the wrong way, and the max power way. Isn't that also the wrong way? Yes, but faster, right? So that's what we have going on there. But I've said the dollar is weak. So how can that be? Because I acknowledge, right, the DXY is up. And the question is, do you want to buy foreign currency or do you want to buy food, fuel, shelter? Right, and so what we have is the dollar appreciating against other currencies while the buying power is dropping, right? And what that means is the buying power of other countries is dropping as well. And the example I gave you guys earlier tonight, imagine our inflation plus 35%, and now you have Japan in yen, right? The thing I would add on OER is it's a deliberate misstatement. The OER was designed specifically to understate inflation. And I've got charts on this, and if you compare the OER to Case-Shiller, it's not lagging, it's just below, right? And that's the issue there. an area where maybe I disagree a little bit. You talked about inflation as temporal, supply side, and I completely acknowledge we had that weird period early in COVID when no one was working, everybody was home, and nobody was spending money on restaurants, cruises, gambling, concerts, right? No one went out. So, and the government was handing out cash. So you had people with a lot of cash, more dollars, chasing fewer goods as well. Of course, we had some inflation there. I would argue that the proof that it was not transitory, I think the cause of it was the helicopter money. Congress printing $6 trillion and literally just mailing out checks. It was like, this is Ben Bernanke's dream fiscal policy, right? Let's just dump money out of helicopters, we'll stimulate the economy. That's what we had. Inflation followed that. I think the proof on my side of it is that prices never came down. If inflation had been transitory, then we would have had lower prices, but we haven't had that. We've had a lot of people mistaking disinflation for deflation. So the difference is, for those of you who want to fondly remember your high school calculus, right? Disinflation is a change in the rate of change. It's the second derivative calculation. It simply means we still have inflation, but slower, right? It's kind of like the opposite of the max power rate. Deflation is a reduction in price levels, and we haven't had that, right? If you look at a chart of the CPI, which I will insist to my dying day is deliberately understated, sometimes by a factor of 100%, and I've done the math on this and written a ton on it. But what we have is the index has continued to go up. It's just going up at a slower rate. And to me, the proof that it wasn't transitory and it wasn't the supply side issues, prices still haven't come down. The only other thing I'd add is that I don't think the tax policy of the United States actually matters. Whether it was the Bush tax cuts, the Trump tax cuts, I don't care. I don't think any of it matters. We have $235 trillion of liabilities, right? So somebody come up with a plan, any plan, without actually doing the thing that Congress isn't going to do until we're in a horrible emergency, which is change our entitlement plan. That's not going to happen. Change our spending, it's not going to happen. There is no level of taxation, of asset confiscation, of theft that our government can engage in, which will produce $235 trillion. So the question is, what's going to happen? Are we going to default like Argentina or Greece? No. I think what we're going to have is what you were talking about, which is a stealth default. And we're simply going to print so many dollars that we will pay our obligations, but we will pay them in fiat currency that just doesn't have a lot of purchasing power. And it may still be a better currency than the yen or the euro, but we're going to get to the point, and it's an exaggeration, but here's your social security check for the month, go buy a pack of gum and a loaf of bread. So that's the direction. We're going to end up with a stealth default rather than an official default.
It's funny, if anybody hasn't read The Lords of Finance, it's a wonderfully written book about how the Weimar Republic hyperinflation came about when the French, who ran the World War I reparations, really forced the Germans to pay back all the debt that they couldn't afford. And so they finally said, fine, we'll just print. And people were running around with wheelbarrows full of money, and there was hyperinflation. Now, whether we're going to be forced to pay all our debt back remains to be seen, but I think that's what it would take for that scenario. One thing I will say about the zero interest rate environment, and I told Pete Stam when he was at JP Morgan this in 2017-18, I said, you really want to cut in half your commitments to venture capital and private equity right now, because I saw excesses in the same way I saw excesses back in 2006 in subprime mortgages. I saw excesses in money going into private equity and venture capital, growth capital. And it was logical that asset allocators were shoveling money in there because real interest rates were negative on bonds. So you really had no way to manage your liabilities by investing in long duration assets because you were not getting paid to do so. But you had to sort of stand down on return-seeking behavior at that point. I actually think you're going to get into vintages now where you can ramp up back to your old annual capital commitments though in the vintages 24, 25, 26, I think you're going to end up with good returns at the end of this decade. So in my research paper, Balance of Uncertainties, I reversed field on that view from 17 and 18. And so that's one thing I think that has changed. I think that in terms of wage increases, we're still seeing 4.2, 4.3, 4.4% wage increases right now. One of the things that happens as a sidebar to the demographic shift is that they measure, everybody's heard of the participation rate in the labor markets, right? They quote the participation rate. Right now it's hovering at its high of 69.3, I think is the number. If I'm wrong, it's 68.3, but it's up there. And it's right at its high. And the Fed has, they have a page, you can go look at it. They report it monthly. The Japanese experience, getting back to Japan here, I'm glad you brought that up because it reminded me of it. What they found is that they thought that the participation rate couldn't go up above a certain ceiling, but it's actually kept going up in Japan, meaning people are working longer and later in life. So the problem you have in the participation rate is a lot of people work between 25 and 54, then 54 to 64 it drops down, 65 to 70, I think they go to 74, drops down again. And what happens is as the baby boomers move through the cohorts, we have higher weights, higher population weights in those last three buckets. So because they're working at a lower percentage on average, you should end up seeing the participation rate falling. Well, we've actually seen the participation rate going up. And that's because people are working longer. And that people think we've reached a cap on that. We haven't. If you look at the Japan experience, we'll actually have a larger workforce and we can actually have higher output than people assume if you apply that to this country. And because we're a larger country and we have much more people than Japan, it actually has a big impact on tax revenues and output. So that's one thing. And the 4.4% wage increases, which is above reported CPI, and who knows if CPI is actually accurate, but we know the wage increase measure is accurate, is incenting people to stay in and join the workforce, which is happening. And I think and that's why we see services inflation higher than goods inflation. And I think that's going to be a sustained element going forward, okay? Because you're going to need to draw people into the workforce. Now, a recession would actually alleviate that somewhat, and we have some lagged effects of the rate hikes that we haven't seen yet. On the other hand, financial conditions are easing. The reason I thought and did some interviews last year that there wasn't going to be a recession was because it's very hard to have a recession when you're at full employment and workers are getting a 4.5% to 5% wage increase. 72% of final demand is consumption, and the consumption comes from primarily workers. We now also have $6 trillion in money market funds, and that $6 trillion is sitting on the sidelines because they're getting paid 2% real to hold cash. Well, when that 2% real dissipates between now and Labor Day, it's going to start going in risk assets. And that's why I think there's going to be another leg to this. I think we are in a long-term bull market, and there's going to be another leg to the bull market because you're going to have earnings growth. We're going to 240 to 248 on the S&P this year. Next year, it's going to be 260 to 275. You widen the bands as you go out. And you've got $6 trillion in money market funds that's suddenly going to be earning the rate of inflation, and it's going to go into risk assets. So I think that for me, those are kind of the dynamics. And unless there's some exogenous shock, like an oil embargo, right? And who knows, Iran and Russia get together and have an oil embargo. Maybe. It's not out of the question.
I know Kunjun has a question, but hang on, I have a question for you first. You're predicting a long bull market.
I think it started in October of 22.
All right, so my question for you on that is in nominal terms or real terms?
Oh, in real terms.
All right?
Yeah. No, I think equities probably have over the next, for the balance of this bull market, not on average over a long time.
I'm just pointing out you can have the
Probably,
indexes up and not have more purchasing.
Right, and by the index, be careful with the index because I think in the research paper I point out the Magnificent Seven is quickly becoming the Nifty 50. And only one stock in the Nifty 50 outperformed the S&P 500 after the 72-73 recession, and that was Walmart. The other stocks all underperformed.
I think that's a great comparison. I know Kunjun has a question.
I'm just curious how you feel about immigration or lack thereof, depending upon what administration will impact everything you're saying. US is one of the only countries where there's an influx of new citizens, future citizens, who drive the economy to a certain extent. That's a differentiator between the US and other countries to a certain degree. How do you feel about that impacting everything you're saying? I know it's probably hard to predict.
Yeah, no, look, it's what you're asking is really a hot button political question. I think what we're looking at is an invasion of the southern border, and that's an issue. That's a problem. We're seeing that in our cities. We are seeing a White House say we're not going to enforce federal law. We have a two-tier legal system where citizens have, in some cases, more restrictions on their legal rights, or at least held accountable by the law, where other people aren't. And I'm skeptical of some of these asylum claims when most of the people coming through are men of fighting age. We're not seeing so many women, so many elderly people. I'd like to see us have a real conversation about what a pro-American immigration policy looks like. And if the country decides that we want to bring in millions of people, okay, great. That's fine. I have no problem with that. But we should decide that and enforce our laws. And what we have right now is a mess that is not going to serve us well.
I think that the southern border issue, it feeds a lot of the political extremism that exists in this country. And it's, and I do agree, it doesn't work for people to run over the border and get health care the next day and have the state of California paying for it. That's a problem. I was just out in California last week, and that is an issue. So I agree with Gary on that point. It should be addressed, like Medicare and Social Security should be addressed. Immigration is very healthy for this country. I wish we had an immigration policy closer to Canada where they really look at people's backgrounds and their skill sets.
Or Australia.
And match their skill sets to a little bit of their economic policy. It's not perfect, but it's pretty good. I mean, I know Canada had a scandal because they were letting some Czech Republic pole dancers come in, and they thought that was a special skill for the politicians. It actually came up, but it was a thing. But I think that. I think immigration has been shown historically to be very healthy if managed well. And I think it's important that we manage it well. Unfortunately, to Gary's point, it's become a very negative element in the socio-political landscape.
I think a guy who wrote a great book on that really illustrates your point, John Krebsky, wrote a book called Cracking the America Code. And he wrote about how immigration has been hugely successful and helpful to the United States. But there's a huge difference because he was looking at the great waves of immigration we had in the early 1900s, where people came and they instantly wanted to learn English and get a job and contribute and be Americans. there's a difference between coming in legally and getting a job and making a rush over the border and signing up for entitlement programs, right? And so those people who came 100 years ago didn't have the option to use up public money.
Scarce resources.
Exactly, and there's a difference in the incentives and behavior of people who come because they want to make a life for themselves, and people who come because they're being offered, free stuff.
Question here.
Bob Stearns from Longship. The Fed got hit with a monkey wrench a couple of days ago. The Houthis hit an American cargo carrier in the Red Sea, and they are all turning around, and they're heading down around South Africa, and container rates are now up 600% in the past couple of days. And by the way, when you get to South Africa, I would imagine the diesel prices are up quite a bit in South Africa because it's the only place to refuel so that you can get to Europe. How is this going to affect the Fed saying, oh, inflation is coming down? Because once this happened, it's not coming down.
Well, I agree with Michael that where we're going to have the long-term problem is on services prices, right? I think that's the real issue. But here's the thing. First of all, I think people who expect the Fed is going to reduce rates by 150 basis points, 6 rate cuts this year, I think that's unrealistic. I would take the under on that. But I'll add to that, if I'm wrong, the circumstances that would cause the Federal Reserve to reduce rates by 150 basis points are not going to be good for the stock market, right? Like either way, it's going to be a negative for the stock market. The best thing that I can say, and one of the things that we talk about at Deep Knowledge Investing is I take issue with this idea that there are good markets or bad markets, right? We've all been trained for decades by the mutual fund companies. You have to be 100% long every day, all the time, no matter what. And any market that goes up, we're making money, it's good. Okay, I don't agree with that. I think we have market conditions that change constantly. And it's our job, if you're a professional money manager, to find ways to make money in any market. And so, like the two things that jump out at me on, for what you're talking about, one, if you really want to hedge that, you can own the VIX. You can own volatility, right? You're talking about long volatility. Right now, the VIX is incredibly cheap. It's below 15. It's 14.7 earlier today. So you can buy that and own future chaos. A second really good option is own energy, right? And so, could these things create problems for the Fed? Yeah, but those don't have to be our problems, right? It's our job to figure out how to make money for ourselves, for our clients, for our partners, right? And if that's the case, and we have shipping problems and ships have to go further, and that's certainly going to affect energy, which does, a lot of it travels on the water, right? So own energy stocks, own oil right now, or in my case, oil and uranium, right? So I would rather than talk about Jerome Powell's problems tomorrow, let's talk about solutions for our portfolios today.
I think Iran is a problem. Yeah. And we've held we've had our foot on Iran's neck long enough. And they're aligned with Russia. Don't kid yourself, I'm guessing Russia is in league with them behind the scenes. And I make no mistake about it, Hamas was funded by Iran and armed by Iran. And so is the Houthis, who don't have anything but cotton to chew on all day, right? So they're high as a kite. They basically have a subsistence living, and these guys show up and say, "Here, we're going to give you money and rockets," right? So Iran is definitely the chaos disruptor. I agree. Ultimately, I think the global economy is improving from the supply side disruptions, and it's interesting because our biggest trade partners are shifting so rapidly. Vietnam is the fastest growing trade partner, and Mexico is now the largest trade partner. And people are onshoring. I was talking to somebody about this yesterday. They're onshoring things because they care about the safety of the delivery, and they want to reduce the amount of things that have to get shipped. Now, it's going to cost more. You know, it's going to cost more to get the chips out of the new $8.5 billion plant in Columbus, Ohio. But there's a learning curve, and apparently they match costs after about 30 to 36 months is what I'm told. Dooney and Bork, who's makes handbags for women, they moved from China to Vietnam, and he said it's going to take them 2 years to get their stitching costs down to Chinese level. So there's a learning curve here as a lot of manufacturing locations are moved either onshore, and that's going to keep upward pressure on labor demand here. But remember that we talked about services. The point I want to make about services is that's an investment theme you want to have in your portfolio. As opposed to goods exposure, you want services exposure if you can get it. I think it's a more sustainable growth in the, Munger, Buffett sort of school of thinking about where am I going to get continued pricing power.
I also would add to what you're saying. We had 40 years of goods deflation by offshoring. And that was accompanied by an unusual period of world peace. And now, not only are we seeing war-related disruptions, but people are realizing, wait a minute, we actually don't want this exposure to China. Or alternatively, we don't, even if we're okay with the Chinese producing goods, we need to get them here. And so we're starting to onshore more of this. And it's going to be a reversal of a 40-year trend of lower goods costs. Now, that doesn't mean that you want to own that stuff in your portfolio because it's higher costs, right? Not necessarily just higher prices, it's higher costs, but that's going to work its way through the system as well, long term, and going to be a problem. There's a question over there.
Yeah, given that we can only see events once they've appreciate and see events once they've transpired, do you think we've entered the trend of so-called undeclared third world war with Russia, Iran, China, issues that continue to increase and cause further tensions? And how do you think this will impact the overall discussion regarding the economics we've had? Thanks.
We've been fighting proxy wars with Russia for decades, right? I mean, on both sides in Afghanistan. This has gone on for decades. It's a proxy war, but the Russians are aware that we've not only provided Ukraine with weapons, we've provided them with intelligence that have allowed them to kill Russian officers. And in addition to that, I've heard some credible rumors, which I can't prove, that we do have boots on the ground there. They're not on the front lines, but we have people in theater. And so it's really just a matter of convenience or luck that the Russians have not openly declared us enemy combatants. Because we might have done that, right? I mean, essentially we did that in 2001, 2002, where, yeah.
I have a question that's related to that, and Michael said something about the defense budget going down. All the money that we're giving to Ukraine and Israel and others, where's that money going? And what effect does that have on our economy?
Well, a lot of it's going to U.S. weapons manufacturers, right?
What's interesting is things have a freshness date on them, and those artillery shells and all that howitzers. Believe it or not, we emptied out stuff that was going to expire or already just expired and built new stuff. So it did increase our weapons production, but it was stuff we were going to have to blow up, oddly enough. Now, we're through that in all likelihood. I will say one thing about Russia, though. Russia's economy is being sustained by military production right now. Russia's got a big GDP problem on the backside of this because they have been forsaken in terms of, They don't have access to any kind of chips technology other than out of China. You don't want China as your only trade partner, believe me, because China is for China. And so Russia has sort of built itself on, it's carving itself out an economic island, right? And I don't mean the Crimea. I mean, they are really going to have a lot of issues in terms of economic growth for the balance of this decade. That worries me. That worries me that there's an intersection of nationalism and economic shrinkage and demographic shrinkage. And by the way, the reason Putin invaded Ukraine is because his ego can't take the fact that Russia is shrinking so fast. He desperately wants to count the Ukrainians who lived in that territory and the children that he absconded with as part of the Russian population. That's a big part of his ego motivation for the invasion, oddly enough, and the UN won't let him have it. They don't count that, and he argues with them constantly about this. But and we can talk about a stupid reason to have a war, but that was a large part of his reasoning is he doesn't want to have the ego embarrassment that his country's shrinking.
As a follow-up, I heard McConnell said on CBS Face the Nation that the money we spent in Ukraine is the best money that we could have spent. He says it's without Americans on the ground. They destroyed 67% of the armaments in Russia, tanks, etc. And the 35 states in the country were actually involved with some aspect of working on production of arms in the United States. So he said it's a really good way of spending the money.
But that'll come out of our GDP too, right? That'll come off the boil. So we have a smaller issue the same way Russia has a big issue because, at the end of wars, what happens? There's kind of this lull that comes after the war and government spending and the military spending, to your point there, it comes down. But then, you aren't making guns, we're going to have to make more butter.
Yeah, I don't know that. I understand the argument that it's stimulating the economy.
I don't think he's saying it for that, but he's saying it's not doing it, but it is.
Understood, but I would just make the point, we don't have a customer on the other side. We're buying those weapons and shipping them someplace else. And whether we're building weapons and shipping them out or butter and shipping them out, whatever we're building, if we're paying for it and shipping it out, we're not getting value for that. What we have is a transfer of wealth from the American people in general, in this case not paid through by taxes, but paid through by inflation, to a few corporations that are making this stuff. I don't know that this is actually a sustainable economic plan. The other thing that I would add is there have been a lot of questions about why we haven't entered a recession yet. And people have said that the economy is better than we think. I'm skeptical on that because we have government spending that adds to the GDP numbers, right? So all of this spending adds to GDP, whether it creates value or not.
Sadly, you covered some of these topics before, but sadly, we may be entering a decade of wars all over between Iran, the Middle East, Russia. So China and North Korea is escalating. What happens in North Korea soon. It's a really bad period we're entering. It's going to be a lot of defense spending.
There was a really good piece I read that we actually are going to get a massive payback from the spending on the Ukrainian situation. And we've been trying to goad Europe to spend more on NATO. We've been carrying too much of the expenditures that NATO incurs. Well, guess what? They have an enemy now.
Yeah.
And they are all going to increase their military budgets and their economic and monetary participation in NATO, which is going to relieve us of some real expenditures that were completely unanticipated. So I think McConnell knows that, and I can't. McConnell may know the magnitude of that, and General Petraeus probably does know the magnitude of that, but that is the one hard benefit economically I think we will get back from the expenditure.
Germany's saying things to Israel now.
And what's the cost of half of Europe becoming an Eastern Bloc? I mean, what's the cost to us of that? I mean, that's massive, right? So there's two ways to measure the cost. One is direct and one's indirect. I would say that there's people who know a lot more than that than I do.
This is super interesting. My question is, how do we do an apples to apples comparison to your point about Japan versus US, because Japan has had 240% of its debt to GDP ratio, US is 120. Is 120 too high? There are certain emerging economies that are 50 to 60, and they are scared that their debt to GDP is too high. Secondly, a lot of debt in Japan is held locally, 90% of it. A lot of debt from US is overseas. In a risk-off scenario, US dollar rises as opposed to everything else, and then in a risk-on scenario, US dollar depreciates. Now, the population is different, so there are lots of interesting nuances and differences between Japan and US. How do we even make a parallel, or what is like the baseline? At this point, this is how we should think about it.
I actually think that's simpler than you might imagine. Just look at what the real interest rate cost of us to borrow money is. That'll tell you. Right now it's high, and the reason it's high is because the Fed is shrinking its balance sheet by about $1.2 trillion a year, which is $100 billion a month. And so I think that's sustaining higher spreads. If you look at Torsten Schlock from Apollo did a nice piece the other day that net foreigners are not selling US debt, but it's shifting from the public sector, meaning governments and central banks, to the private sector. So more private sector investors, including pension plans, are holding US denominated debt, but it's not changing that much. China has had to sell down because China's got a cash flow problem, right? But the UK and Belgium, oddly enough, I don't know Belgium, but and Japan are holding more, and it's almost net neutral. The composition is shifting, but I think you look at where real interest rates are along the curve, and that tells you what is the ultimate cost of that, and is it coming down? And I think the inflationary risk, perceived inflationary risk coming out of the system, will bring that down. But the Fed's still got 3.5 years of balance sheet shrinkage. They got to get from about 7.8 trillion down to, I think, the steady state number is going to be 4 to 4.5 trillion. So they still got about 2.5 to 3 trillion to get off that balance sheet.
Yeah, I agree with that. I'd add a couple of things. One is in Japan, the Bank of Japan basically owns everything. There were weeks, not last summer, the summer before, where 100% of securities trading in Japanese government bonds was the Bank of Japan. It is the most manipulated market. There's no price discovery. They just own all of that. And so how they sort that out, I have no idea. I think the issue in the US is our massive rate of spending means we have no flexibility. And again, to repeat a point I made earlier, I think Congress believes they've discovered this magical way to fund everything. There are no trade-offs. We're just going to spend more and more and more and more. And keep in mind, when people talk about these massive spending cuts for our government plans, they're not actually spending cuts. It's something I deal with in counterintuitive inflation. It's simply, again, sorry to remind all of you of your high school calculus, it is a small reduction in the rate of future increase, right? So we're saying we'll spend more, but slightly less more, so we're going to call that a spending cut, and then they yell at each other saying you want people to die, you hate people, you're cutting spending. Nobody's cutting spending. And so we have no flexibility. Now, the final point I would make on this is the Saudis have broken the petrodollar. They've already started to take payment for oil and other currencies. That trend is going to continue. And with the decline of the petrodollar and with more than half the world trying to de-dollarize, the share of the US dollar as the world's reserve currency has been sliding for a couple of decades now. It's now down to 59%, and some of you might say, wait, that's pretty good. It is, but it's coming down, and half the world is trying to get off of that. Just remember Michael's point. More questions. All right, okay. Michael's point is a key one, right? Which is who owns that debt? So what happens when all of these US Treasury bonds overseas are held by people who say, I don't want to own this anymore? Well, they send them back here, and the only thing they can do with it is either flood our system with dollars, that creates inflation, or use it to buy lots of assets and create an asset bubble / inflation. It's a problem.
Wait, one more question back there.
Appreciate our currency and all of that gets wiped away.
That's the self-default I talked about. You could write the next book.
Tom.
It's okay. You just addressed it in terms of the world reserve currency.
Yeah.
Well, any other questions before we close?
I had a question for Michael. He brought up a really good point about like people staying in the workforce, and it's very optimistic. But the average American life expectancy is so much lower compared to Japan. And as somebody who works in healthcare, I was thinking the average American is very not able to work till 80s, as in countries like Japan and Italy sometimes. So it would be optimistic for people to stay in the workforce longer, but there's so many other aspects we would have to target in terms of healthcare for that to happen.
It's an interesting demographic issue because we suffer from a big healthcare issue in this country, which is obesity.
Oh yeah.
That's going to prevent people from working longer. In Japan, they used to force people to retire, like it was mandatory, right? In this country, they don't do that as much explicitly. It may be implicit, but it's probably going to become less implicit. So I think there's a little bit of flexibility. So there's countervailing forces, but I think that again, Japan's 15 years ahead of us on this demographic bubble. China's 15 years behind us. Europe is contemporaneous with us. As we push through this, I think one surprise is going to be that participation rate is going to drift upwards, even though it should not drift upwards. As that population bubble moves through those older cohorts who have lower employment on average, what's happening in those older cohorts is employment is going up. And it's all relative from where you started, right? But I think that it's amazing to me that participation rate is near an all-time high. And there's even more people to come into the workforce. They've estimated something like 3.6 million people. And I can't remember, what was it? Immigrants have come into the workforce, but people who are not immigrants haven't. I saw this chart the other day and I thought that's interesting, but the higher wages are attracting people into the workforce, right? And I think that we will see that participation rate coming up, and that will support, on all things being equal, higher GDP growth. I think we will follow something that rhymes with what Japan has experienced in terms of the participation rate being higher than anybody thought it could be.
Well, thank you very much, Gary and Michael, for such an interesting discussion. We appreciate your time and insight. On behalf of the Roundtable, I want to thank everyone here tonight for being here. For those who are non-members, again, we are a nonprofit industry organization. We're committed to promoting education and best practices in the industry. Please do sign up, become a member. Our upcoming events, February 27 is a panel on private equity investing in sports. March is a discussion to celebrate International Women's Day. And April is in the works with a investing in commodities discussion. So please be on the lookout for more details, and thanks everyone. Please stay back for some drinks and little bites of food and networking. Thank you very much.